Hello and welcome. I'm Kelly O'Byrne and it's time to take a look ahead at what could drive the markets this week. Last week we saw the Dow Jones reach the 22,000 mark for the very first time and the euro-dollar broke 119 to its highest since 2015. We also had some big events including Apple earnings, the Bank of England meeting, as well as non-farm payrolls. But before we discuss all of that and more, I'd first like to give you a rundown on some of the key events coming up this week. We are now in the back half of earnings season, but there are still some top-tier results to either trade directly or watch for their influence on equity indices. On Monday, we have Santander UK and Marriott International. On Tuesday, Intercontinental Hotels Group, Michael Kors, Standard Life, Worldpay and Walt Disney. On Wednesday, it's G4S and Legal & General. On Thursday, Cineworld, Prudential and Snap. And on Friday, we have Old Mutual. We've also picked out what we think could be the most market-moving economic data releases next week. So in chronological order, we have China trade data and CPI, the Reserve Bank of New Zealand rate decision, EIA crude oil inventories, UK industrial production, German and French CPI, and finally US CPI. Now, to discuss the state of markets, I'm joined by LCG's Head of Research, Jasper Lawler. Hi Jasper and welcome. So Jasper, I mentioned earlier record highs on Wall Street. How are you viewing the stock markets?
Well, yes. I think at one point we had 6 days of record closes on the Wall Street in a row. So obviously we're still in major bull market territory overall in equities, goes without saying. But it is getting a bit more interesting now in terms of the relative performance of some of these indices, the ones that we track particularly. Why is Wall Street doing particularly so well? I would say it's pretty much well attributed to earnings season. We mentioned Apple earnings. Apple had a solid set of results, better than it was expected. Year-on-year growth in pretty much every metric that you follow. They're a big component of the Dow. The oil companies returned to profit growth again, so they're again a big component of the Dow. But things like technology companies, obviously Apple falls into one of those, but not so great results from Amazon. Fairly decent results from Facebook and Google, to be fair. But nonetheless, I think you can say that the NASDAQ and those tech stocks have been underperforming. So one of the questions for US stocks is this just a healthy rotation from tech into some more industrial-based companies? Or is it actually tech is leading the way and the Dow is just a bit slow to catch up with what's actually going to be a bit of extra weakness? It's one of those two scenarios. The other thing you can see is that the DAX, notably weaker than the US indices, even than the FTSE. I think that's pretty much currency related. I mean, the euro has been on an absolute tear, and that's just not good for German exporters. So that correlation goes back and forth in terms of its strength. But I think at the moment that you can't deny that if the euro keeps breaking out like this, that's generally not going to be a good positive factor on the DAX. It can still move higher, but at the moment it's not, obviously. And a similar factor with the FTSE and the pound. Obviously, we had the Bank of England meeting last week. The pound dropped after that, so maybe that's a cue for a bit more strength in the FTSE going forward.
Mm-hmm. And also, so we saw the euro break 119 and the pound dipped a bit after the Bank of England meeting as well. Moving forward, what should we look out for in the Forex market?
Well, when it comes to the euro, I think there's a fairly straightforward dynamic going on at the moment where it's pretty much that the yield spread between Germany and the US is compressing. So German yields are going up, US yields are coming down. That's a good thing for the euro, it's a bad thing for the dollar. Euro-dollar goes up. That's pretty much what's happening at the moment. I think probably, even though the Fed are looking to raise rates, ECB not so much, it's something we've been talking about for a while now, is that actually the Fed are not going to be as aggressive as they previously stated. And so you just have to pare back some of that. And it's not just the euro rising against the dollar, although the euro is the obvious counterparty. It's the second most important currency in the world, you could say. So when you're selling the dollar, because you're not so confident the Fed's going to lift its rates as quickly as we previously thought, typically you're buying a euro against it. That's just the kind of dynamic of it. And obviously European growth has been good too. So obviously we'll be watching that European data coming out next week. There's not so much of it. but generally the trend is good. Economic data from Europe. Talking about the pound, obviously, we had the Bank of England meeting last week. There it was sort of, the rhetoric was quite hawkish, but the numbers were dovish in that basically their forecast for growth was lower and they pretty much kept the inflation forecast unchanged. So if anything, if any justification was there for a rate hike, it's that their inflation is going to be picking up, but they don't seem to be thinking it is. So it seems like no rush to raise rates from the Bank of England. Obviously, the central bank meeting we've got next week is the RBNZ. I suspect it's going to end up panning out fairly similar to the way it did with the RBA, in that there's a bit more expectation. There's been a breakout in both those currencies, the Aussie and the Kiwi, but I don't think the central banks are going to really deliver on the rate hikes just yet. So maybe a bit of disappointment on the cards. And as we're speaking, there's bearish engulfing candlestick on the New Zealand dollar pair.
Okay. You did say last week that you thought a sell the bounce opportunity was near in oil, and it did head lower last week as well. Do you see commodities softening further from here?
Well, that was, it was largely the 50 level in US oil, which proved to be a bit of resistance. But actually, even though oil soft throughout most of the week, we had quite a decent bounce back. And the levels that I'd been mentioning previously, not relating to US crude, but to Brent, are still a bit higher. So I think we can still potentially push above. I think in general, what's driving oil at the moment is positioning. It's not that the fundamentals have really changed. So why is oil plummeting for 2 weeks and then suddenly skyrocketing for another 2 weeks? Mm-hmm. Has something fundamentally really changed in that month? I don't think it has. I think it's just that markets got very bullish oil. The data wasn't quite there to justify it. There was a lot of short covering at the lows. So it's positioning back and forth, and so I think at some point, probably not too far away, again still, it's going to switch the other way, and people have gone a bit too long without any real change. Gold obviously has been doing very well because the dollar's been doing so badly, but one thing I would point out is that the US dollar index is at a 15-month low, but gold is still below its recent highs, so it's actually benefiting from this dollar weakness, but maybe not as much as it should, showing a bit of perhaps inherent weakness in there. So if the dollar gets a bit of a bounce back, I would expect gold to based on that relative underperformance, for gold to fall off a bit more dramatically. Okay.
Thank you so much, Jasper, and thank you for watching. Don't forget to follow us on social media to get the latest research as it's released.